Modern algorithmic trading operates in a reality where quantitative models execute orders in the space of a few milliseconds. Yet, despite this extreme technological sophistication, nearly every trader relies on a single, archaic default setting when applying the MACD indicator to their charts: 12, 26, and 9. These three numbers are the default parameters for the moving average convergence divergence. It is the undisputed cornerstone of momentum trading, used by millions to navigate global markets every day. Retail and professional traders alike often treat this specific sequence as a sacred mathematical constant, but academic research suggests that applying these rigid parameters to a dynamic market doesn't provide an edge, it actually destroys it. By blindly accepting these defaults, you are trading on a legacy configuration that became standard purely through the repetition of early charting software. It wasn't a discovery of a universal market law. It was simply the first set of numbers preloaded onto a screen, and by using them, you're surrendering your statistical advantage to a historical accident. To understand the origins of these numbers, we have to look back to the late 1970s. The legendary technical analyst Gerald Appel invented the MACD during an era when market data was still being read off of physical ticker tape. However, there is a massive discrepancy between how Appel designed the tool to be used and how modern digital platforms have rigidified it into a one-size-fits-all button. This investigation focuses on a specific problem, that treating 12, 26, and 9 as a universal setting ignores the unique volatility of different assets and systematically erodes a trader's performance. To survive in quantitative trading, we must put the MACD on trial. We need to strip it down to its mathematical bedrock and relearn how to manipulate its variables the way its creator intended. At its core, the MACD is an attempt to capture price momentum through a simple equation. It measures the distance between two wave frequencies, a fast exponential moving average and a slow exponential moving average. The look-back period variable determines the sensitivity of these waves. In the default configuration, the 12-period average reacts quickly to recent price changes, while the 26-period average drags behind it. To generate a signal, the formula adds a 9-period EMA of the MACD itself, the signal line. When the MACD line crosses its signal line from below, it creates a geometric intersection that traders use as a trigger to enter the market. But because these lines are averages of historical data, they are inherently backward-looking. This design guarantees that the indicator will always lag behind real-time price action. Since the MACD is simply measuring the delayed interaction of past prices, treating a crossover as a predictive guarantee of future movement is a core mathematical fallacy. To find the solution, we have to look back at Gerald Appel's original instructions. He didn't tell traders to stick to one static set of numbers. He told them to be dynamic. For generating buy signals in an uptrend, Appel explicitly recommended highly sensitive, fast-acting inputs, 8, 17, and 9. On this chart, the 8-17 setting on the left catches the momentum at the very bottom of the dip, well before the default on the right even reacts. But for selling, he recommended the opposite: slower, less sensitive inputs like 19, 39, and 9. This configuration ignores minor, temporary price drops, keeping you in your position during a volatile advance. This is the logic of parameter asymmetry. You buy fast to catch the early burst of an uptrend, but you sell slow to avoid getting shaken out by a brief market reaction. The market itself is asymmetric. By forcing a perfectly symmetrical default setting onto dynamic price action, modern platforms ensure your indicator is constantly out of sync, significantly increasing the probability that you will enter too late or exit too early. This structural flaw becomes even more dangerous when we try to use the same parameters across entirely distinct assets, moving from the stock market into physical commodities like gold. This is cross-market heterogeneity. Every asset class has its own unique volatility profile, liquidity depth, and structural cycles. This data, derived from an 11-year backtest, compares the optimal MACD settings for equities versus gold. The results are striking. Equity-optimized settings generated over 2 trades per month, while the optimal settings for gold were twice as slow, averaging fewer than 1 trade per month. The data shows the standard 12-26-9 configuration works passively in equities because it aligns with the short-term cyclicality of the stock market. But in the gold market, that same setting is pure noise. Gold requires a much longer look-back period to filter out the false signals that plague shorter-term traders. Forcing an equity-optimized look-back onto an asset with a different cycle ensures your indicator is desynchronized from the price. You end up entering the market precisely when the institutional money is already exiting. Once traders realize default settings are flawed, they often fall into the opposite trap, curve fitting. This is the practice of over-tuning your MACD variables until they perfectly match a specific slice of historical data. A curve-fitted strategy will look flawless on paper, but it will collapse in a live market the moment the economic or political environment changes. Indicators map historical probabilities, not future certainties. Tuning them to fit yesterday's anomalies ensures they will fail when they meet tomorrow's reality. The actual solution is explicit, dynamic calibration. As this dashboard shows, the parameters must shift in response to the market regime. By moving from a 12 to a 15-period fast EMA, you can actively smooth out the line and eliminate false crossovers. The MACD is a measurement tool. Just as you wouldn't use a thermometer to measure wind speed, you cannot use a single setting to measure all market conditions. Strip the default settings from your charts, learn the mathematical mechanics of your tools, and backtest your parameter ranges against specific environments. True alpha isn't found in a magic combination of numbers. It is generated by traders who understand that calibration is the real edge and who choose to trade the data rather than the software's defaults.